Well, highest quality, no event risk, and one of the most secured investments available. That's Joseph Fichera's thoughts on the nation's hurricane recovery bonds. Joseph's firm, Saber Partners, advising and helping to implement this new program in Florida, and he joins us now to talk more about this. So hurricane recovery bonds, clearly a timely issue with Wilma and, of course, the aftermath of Katrina still in the minds of investors. Tell us really what is a hurricane recovery bond and why now?
Well, actually, this was a foresight of the Florida legislature that started back in 2004 because of the hurricane damage in Florida. That special legislation was passed to allow for applications of this special type of bond. It's called a hurricane or storm recovery bond in Florida, but it's really part of a family of fixed income instruments called utility fee bonds or ratepayer-backed bonds or stranded cost bonds. These are a special bond that is supported by a charge on everyone's electric bill and wrapped by a government guarantee to always raise the charge to whatever level is necessary to repay the bonds. You know, a government regulatory guarantee, not a full faith and credit guarantee. And that gets it AAA ratings and, as I say, the highest security bonds apart from treasuries, I think, in the capital markets.
These are municipal bonds?
No, they're not. They're actually corporate bonds. They go through a special purpose subsidiary of a utility, a sponsoring utility, and the charge goes on everyone's bill. It is collected, and when that's sold to investors. And the proceeds then go to the utility for specific purposes. In Florida, it'll be going for hurricane recovery and storm damage. In Wisconsin, it'll be going for environmental facilities. In Texas, it'll be going to recover costs associated with deregulating the energy market. So the use of proceeds is a corporate function and through a corporate structure, but as I say, it has a government sponsorship and a government involvement, a government guarantee of its regulatory authority to ensure repayment, and that's why investors like these.
What kind of a premium would an investor expect to capture over a comparable AAA-rated treasury?
Oh, you know, that is
if any.
No, yes, that's we have in negotiations with the underwriters about that. I think right now they trade anywhere, they've been priced anywhere from 45 to 60 over U.S. Treasuries for a 10-year maturity.
You're saying 45 to 60 basis points, about 0.5% for
That's what they have been historically, and that's, you know, from a perspective of the security and quality of these securities and liquidity, it's kind of cheap, it's kind of high. They should probably trade more closely to agency security, U.S. agencies like Federal Farm Home Credit or Fannie Mae and such, or even it's like a Johnson & Johnson, a AAA Johnson & Johnson. They're high quality and they're sort of for the buy and hold investor.
High demand, do you think?
Yes, there's always been a strong bid for these bonds whenever they've come out. They have not been a consistent issuance over the past 7 years. They've sort of had a start-stop aspect. But right now, it's starting to expand, and that's why you see the hurricane recoveries in bonds in Florida, probably a precedent for the Gulf region, and for other places like infrastructure transmission.
That's going to lead me to my next question. This thing is going to be catching on and expanding, you think, in other regions and other aspects that are dealing with these sort of one-time shocks to their financial systems?
Well, yes, that's one, but I think people are starting to see it as a broader financing technique. In the last year, 3 separate states passed new legislation to authorize this, and one of them, Idaho, actually allowed it to be used for any purpose that the utility normally invests in. It's up to 40% of its balance sheet. So it could use it for not only just environmental upgrades of its plants, but transmission and distribution lines and other kinds of things. In the past, it's been for these rifle shot kind of one-off kinds of things, shocks like you say, hurricanes, stranded costs, environmental. But now it's going to a broader base because in the end, regulators and utilities are concerned about what the customer is paying. And this is the lowest cost financing technique available out there in the debt markets. And as you do more project financing, more debt financing to build the infrastructure, we're going to be looking the way to keep rates down and still be able to fund this, get it from the capital markets.
We have about 30 seconds left. I just want to get your closing thoughts on this. So you see this expanding, being well subscribed to. When might we expect this actually to come to market, something like this?
Well, in Florida, the possibility of applications is right now, and so we really think that's more of a first quarter. There probably will be issuance out of Texas of about $2 billion in the fourth quarter, maybe about $1 billion out of California, and then Wisconsin and New Jersey in the first quarter of another maybe $500 million.
Joseph Fichera, thanks very much. Appreciate you joining us today, this morning, to give us some insight on a really new development, a big development in the bond market. Well, still to come on the Morning Call, Google